The textbooks say the Great Depression was a random disaster that blindsided an innocent banking system. But buried in banking ledgers is a different story, where disaster arrived as a solution, not an accident. Every dollar in your wallet follows this pattern of leverage, shock, and rescue, whether you see it or not. In September 1929, 2 months before the crash, America's major banks were already technically insolvent behind polished marble walls. Reserve ratios at leading institutions had slipped below requirements, yet regulators stayed silent because honesty meant immediate nationwide bank shutdowns. This wasn't just speculation gone wrong, it was a decade-long decision to overextend credit far beyond real reserves. So when markets finally broke in October 1929, the crash didn't cause the banking crisis, it solved it politically. To see why banks needed that collapse, we have to watch how they built their own trap during the Roaring Twenties. Between 1921 and 1929, bank loans expanded roughly 63%, while their actual reserves grew only about 10%. Margin lending became the business model, with around $8.5 billion in broker loans, supporting stock purchases at 10% down. That meant every real dollar of capital was stretched to support about $9 of stock market exposure. Banks didn't just finance the boom, they owned it, building investment trusts packed with their own shares and favored clients. They lent money to buy stocks in companies they effectively controlled, creating a circular dependency between prices, credit, and reputation. Real estate amplified the danger, as banks poured money into Florida land schemes where values existed mostly on maps, not income. When that land boom cooled by 1926, Southern banks quietly held piles of shaky mortgages they dared not admit were bad. Cities like New York, Chicago, and Los Angeles saw property values triple on paper, pushed more by lending than by rents. Agriculture formed a third weak pillar, with banks rolling over loans to farmers whose post-war crop prices no longer covered debts. By 1928, many Midwestern agricultural banks were solvent only on paper because constant refinancing masked loans that couldn't be repaid. The gold standard turned all of this into a mathematical trap, limiting how much currency could actually back ballooning deposits. Even the Federal Reserve, created to stop panics, was chained to gold reserve ratios that capped its emergency lending capacity. By the summer of 1929, the crisis wasn't hypothetical. It was unfolding quietly in boardrooms stretching up and down Wall Street. Partners from major houses met in private, telegrams crossing the Atlantic as insiders quietly sold positions while reassuring the public. Newspaper editorials talked about fundamental strength, but many of those outlets relied on big banks for ownership, credit, or advertising. Behind the comforting headlines, call money rates for margin loans jumped toward 20%, and banks hesitated to lend overnight. When statistician Roger Babson publicly warned of a coming break, financial voices mocked him and quickly steered attention back to optimism. Bankers understood the system was so fragile that even a small disturbance could cascade. They needed either distraction or reset. They received both when the stock market broke in late October, turning years of quiet imbalance into a single dramatic event. So the real question isn't why the crash happened, but why it happened exactly then, after months of visible strain. On October 24th, prices fell sharply, and the official tale blames emotional small investors dumping stocks in uncontrolled panic. Yet trading records reveal large institutions selling in unison at the open, then publicly announcing support to appear stabilizing. The following Monday and Tuesday, prices fell further, wiping tens of billions in paper value from a system already overstretched. This is how a market panic becomes a cover story for a banking rescue operation, hidden in technical language. Within days, the Federal Reserve cut rates and began buying government securities, injecting liquidity directly into the banking system. Discount window lending quietly flowed to large institutions first, and notably, those same big banks somehow didn't immediately fail. Instead, the crash itself became the explanation for every bad loan, masking the reckless policies that had preceded it. Over the next 3 years, roughly 9,000 banks closed, mostly small community institutions far from Wall Street's speculative towers. Meanwhile, large New York banks expanded, acquiring failed competitors' assets cheaply and doubling their own balance sheets during the Depression. Financial firms that orchestrated rescues often took board seats and influence at surviving banks, trading lifelines for long-term control. The Federal Reserve's lending choices decided who lived and who disappeared, and connections to major money center banks mattered most. Hoover's Reconstruction Finance Corporation added another filter, lending about $1.5 billion, while steering most funds toward a small group. By 1933, America had gone from about 25,000 banks to roughly 14,000, with assets concentrated in far fewer hands. But to lock this new structure in place, the consolidators needed something more powerful than credit lines. They needed law. Franklin Roosevelt entered office in March 1933 as state-level bank holidays spread, leaving depositors temporarily unable to access their accounts. Within 48 hours, he declared a nationwide bank holiday, closing every bank and giving management time to rearrange balance sheets. 3 days later, Congress passed the Emergency Banking Act in a single day, with many members never fully reading it. The act empowered the President and Treasury to decide which banks reopened and allowed new currency backed by broad assets. Officials quietly sorted institutions into 3 classes, with large urban banks usually cleared to open while many rural banks stayed shut. Roosevelt's fireside chat then framed reopened banks as safer than mattresses, and depositors dutifully brought their cash back inside. This is how confidence theater still operates on your savings balance today, through reassuring speeches backed by selective support. Yet the solvency problem remained, so on April 5, 1933, Executive Order 6102 required citizens to surrender their monetary gold. After collecting coins and bars at about $20 per ounce, the government soon revalued gold near $35 by law. The gain was effectively transferred to the central banking system, which used it to expand reserves and quietly absorb bad loans. Losses from the speculative 1920s were thus socialized onto citizens whose gold had been removed and repriced without recourse. Glass-Steagall, passed the same year, separated commercial and investment activities on paper while nudging business toward already large institutions. Big banks could afford multiple entities and departments, but smaller banks often had to choose one narrow role and surrender others. Federal deposit insurance calmed depositors, but it also meant banks could take greater risks, knowing losses were ultimately pooled. The new securities regulator added complex reporting rules that small firms struggled to meet, while major banks helped draft those standards. The exact same pattern applies to modern regulation. It looks protective but quietly favors the largest players in every cycle. By 1935, a handful of giant banks controlled more than half of U.S. banking assets while representing only a tiny fraction numerically. The Federal Reserve emerged with expanded authority, looser gold constraints at home, and greater independence from direct legislative pressure. What was sold as insulation from politics increasingly meant the money supply sat under expert management with limited direct public oversight. The Depression years created a template repeated ever since good times: leverage, shock, emergency rules, rescues, then consolidating reforms. In 2008, the pattern resurfaced as mortgage-backed securities and derivatives stretched bank balance sheets far beyond safe historical norms. When housing faltered, emergency programs injected trillions, weaker firms were absorbed, and the largest banks increased their market share. Post-crisis reforms like Dodd-Frank imposed heavy compliance costs that small banks struggled with, while large firms hired compliance departments. This is happening to your paycheck right now as fewer banks control more of the credit that shapes prices and wages. In 2020, extraordinary lending facilities and asset purchases again stabilized major institutions, while many smaller enterprises simply disappeared. The result was another large wealth shift upward, with asset owners gaining while many wage earners faced shrinking options. Today, large banks carry derivatives exposures in the hundreds of trillions, plus significant sensitivity to interest rates and commercial property. Recent regional bank failures quietly ended with their assets sold at discounts to already dominant national institutions. The next triggering event could be health-related, technological, or geopolitical, but the specific spark matters less than the familiar script. The exact same thing is happening today. History repeats because very few people are taught how this pattern actually works. Emergencies grant permission for actions that would be rejected in calm times, and temporary measures often become permanent arrangements. Real financial security starts with recognizing when the cycle is repeating instead of relying only on comforting official explanations. Banks needed the Great Depression to survive their own excesses, and the only open question now is which emergency supports the next consolidation.